All right, welcome and thank you so much for being here today. We host these financial workshops with Mountain America Credit Union on the third Thursday of each month from 12 to 1. They are recorded, so if you want to watch again or if you want to send to a loved one or coworker who could benefit, we would highly encourage you to do so. And of course, you can receive wellness points for joining today, and I'll actually show you how to do that. So, can I get a thumbs up if you can see my Wealth Steps page? Thank you. Excellent. So, you will log your workshop participation today by clicking on Rewards. And remember, your Wealth Steps login is your EIN as your username, and then you create your own password. So if you're unable to log in or the password isn't matching, you can just do the forgot password feature to get that reset. But once you're in, you'll click on rewards. And then you'll see here that we are under February. So these are all the activities you can receive points for. There are a lot, but what we're searching for will be classes, workshops, and podcasts. And we have them all labeled here for February. So today is all about investing basics. So you would just click that you attended today after you have submitted what you learned. So you'll just put here, I learned all about investing and how cool it is. You'll put something actually specific. This is just my example. And then you'll mark this checkbox. It'll show pending, and then we go through and actually make sure that it is a real comment and it doesn't just say blank or something like that. But that is how you log points for wellness workshops. Let me know in the chat if you have any questions about that. And I will turn the time over to Scott, our financial education manager for Mountain America, to get us started on investing.
All right, let me pull up the correct screen to share. All right, looks like we're good, yes?
Yes.
See the screen, sweet. Okay, so I do have my chat open here. If you've got questions along the way, we are gonna try to shoot this for about 40 minutes left now. So I'm gonna try to run through this quickly because this is one of my favorite topics to talk about. I love to talk about investing, mostly because I think a lot of people are intimidated by it, and I don't want you to be intimidated by it. I want you to be excited to get going. If you're already going, I want you to get excited about what you're doing and what more you might be able to do. So let's dive right into it. What we're going to talk about today is to help you recognize the effect of time on your savings, to help you understand some common investment options, give you a good flavor of the difference between risk and volatility, and then help you recall some of the different types of investment accounts that you might have available to you. So, first thing we want to talk about is the effect of time on savings. We want to see how even small contributions over time can make a big difference. And so we are going to start with a story. We're going to start with a story about a penny. And this is a very special penny. This penny is going to compound. It's going to double every day for the next 30 days, right? And so today it's worth 1 cent. Tomorrow it's going to be worth 2 cents. The next day it's going to be worth 4 cents, and so on and so forth. And it's going to do that for the next 30 days, right? For the next month. So we're going to play a game here. Everybody on your little thing where you can raise your hand, put your hand in the air. Let me see. Everybody put your hands up on the screen. And we're going to take some polls here. Hopefully we can see everybody doing that. Okay, I'm starting to see them coming. Cool. Okay. So everybody find the little hand up there. Okay, what we're going to do here is we're going to do a quick survey about how much you think this penny is going to be worth at the end of 30 days. Okay. So everybody with your hands up in the air, you think, if you keep your hand up in the air, you think this penny is going to be worth more than $100 after 30 days. So if you think it's going to be worth more than $100, go ahead and keep your hands up. Saw a few coming down. All right, several coming down. Okay, if you think it's going to be worth more than $500 in 30 days, let's keep your hand up. A few more coming down. So we got maybe about half a dozen of you so far think it'll be worth more than $500.
Te digo ahorita porque tengo que contestar.
How about more than $1,000? If you think it'll be worth more than $1,000 after 30 days, keep your hand up. 3, 4, 5, 6, 7, 8, 9. Looks like I got about 9. How about think it'll be worth more than $10,000? More than $50,000? Still have a few folks who think it'll be worth more than 50K. How about more than $100,000? We think this penny is going to be worth more than $100,000 in 30 days. About 500,000. There's still, looks like maybe 6 hands up. More than $1 million. More than 2 million. Now hands are coming down. Let's see, we got 1, 2, 3, 4 people think it'll still be worth more than 2 million. How about more than 5 million? Let's go big. Looks like we got 2 people. All right, so let's see where we end up here, right? A lot of people thought it was kind of somewhere between the $500 to $1,000 range. So after our first week with our magic penny, on day 7, our penny is now worth 64 cents. Okay, so day 1, it was worth 1 penny. Day 2, 2 pennies. 3, 4 pennies. So we get to 64 cents after a week. After 2 weeks, we're up to 81.92. Not bad, right? Our penny is making some money for us. After 3 weeks, our penny's actually worth a little over $10,000, right? $10,485. After day 25, our penny is now worth $167,000. Day 26, we cross 330,000. Day 27, 671. Day 28, 1.3 million. Day 29, 2.6 million. On day 30, our lowly penny has doubled and doubled and doubled and doubled. It is now worth $5.368 million. All right, so we had a few people who actually had that, but a lot of people didn't get there, right? Now think about that. Our penny doubled. It just kept doubling and doubling and doubling. This is called compounding. So this is something that you'll often hear this quote that Albert Einstein called compounding the 8th wonder of the world. I will tell you the accuracy of that quote is not necessarily there. It's a great internet thing, sounds really good, but guess what? It is, compounding itself is that magical. It really is a very impressive thing. And so we want to talk about compounding because this is one of the most important ways that you're going to be able to build wealth in your lifetime. So there are 3 parts to compounding. First one is the starting value, right? And so in this case, the starting value is a penny, right? We had 1 penny, that was our starting value. The other 2 parts of it are time and the rate of return. Now, for our penny, our rate of return was 100% every single day, and the time that we had to do that was 30 days. Now, are you going to find good investments that you're going to be able to get 100% return every day on? Probably not, right? If somebody tells you they got one for you, I think you're probably being scammed. But compounding itself is real. So if we think about the penny that we just had, right, it was worth a ton of money after 30 days. It was worth over $5 million. But earlier on, it wasn't necessarily that impressive, right? How would you like to own that penny maybe only for 20 days, right? When the value of that was about $5,000, or 10 days when the value was about $5. Those are still good returns on a penny, but not $5.3 million, right? You're probably less excited about having that penny when you see that the numbers are, $5. You can probably come up with $5 some other way. But the thing is, compounding, the time is really, really important. And so the more time that you have for the compounding to do its magic, the more you're going to see that big effect, the more you're going to see that snowball grow into something huge. And so right now, today is the time that you have the absolute most time available to you for any of your investments to grow, for that compounding to do its magic, right? And so whether that's 10 years, 20 years, 30 years, today is the time that you have the most amount of time available for you for whatever your investments are to grow. So let's look at what that might look like in real life, right? Not a magic penny. So we've got some people here. We've got people of different ages. So we've got people age 18, 25, 32, 39, 46, and 53, right? And these people, they're each starting with absolutely nothing in their retirement plan, but they all want to become millionaires by the time they turn age 65. So for simplicity, we're going to assume that yes, they all are starting from the same place, right? $0. They all want to get to the same place, 1 million by age 65. And to get there, they're going to invest in something that we can say is, relatively safe. The S&P 500 index over the past 100 years has returned an average of about 10% per year. So that's the return that we're going to use. Remember, our penny was doubling 100% every day. We're talking about 10% per year on average over the time that these people are going to invest. So how much does each of these people need to invest every month in order to become a millionaire? Well, let's start first off looking at the extremes, right? We're going to look at the 18-year-old. If Elise, starting at age 18, saves just $79 per month, she's going to be a millionaire by the time she turns 65. $79 a month. Aaron's going to have to save more, right? Because Aaron starts at age 25. Aaron has to save $156 per month. Beth at age 32 is going to have to save $309. Hector at age 39 is going to have to save $626 a month. Sophia at age 46 has to save $1,323. See, now we're getting into things like a mortgage payment, right, every month. And then Brad, our late starter, starting with $0, is going to have to save about $3,090 per month until he's 65 in order to become a millionaire. Now, let's look at how much in total those people are going to have to invest, right? So Elise, remember, age 18, starts early, doesn't have to save that much. Saves $79 a month between age 18 and age 65. That's a total of a little over $45,000. $45,504 is all Elise has to save. The rest of the over $950,000 in Elise's $1 million account comes from compounding. It comes from the time that Elise had to let that money double, to grow over time, okay? And so if you see, Aaron at age 25 also doesn't really have to save that much according to, the math to see $1 million at the end, 76,000. Everybody has a little bit more that they have to save the later that they start, right? Because they have less time for their money to compound. But even Brad, who starts really late comparatively, only has to save almost half of the amount of money himself in order to get to be a millionaire. over half of that money is going to come from the growth in his investments at an average of 10% a year. So you can see why time can be super, super powerful, even when you don't put that much in. It's that little amount over that longer period of time that can do a lot more heavy lifting for you. So let's ask the big question then. How much should you personally save? The answer to that depends on a lot of things, right? Maybe you don't feel like you need to be a millionaire. Maybe you want to be a multimillionaire. Maybe you've already started, right? Maybe you've got all sorts of different things going on. What you don't need to know is the right answer in order to start doing the right thing, which is to start doing your future self a favor and either start investing a little bit now or start investing more if you think that that's where you need to be in order to get there, right? So you don't have to be starting and say, oh, okay, I'm going to save exactly how much I need to save every single month from now until then. Just start with a little bit more, right? Get yourself going, and then you can course correct along the way. But just that act of starting is going to make a big difference. But let me give you sort of a rule of thumb that you can use to kind of understand, all right, well, based on, how much time I have and where I'm trying to get, how much should I save, right? This thing called the rule of 72. So it's an easy shortcut that helps you figure out this whole compounding thing, right? What it means is compounding happens faster if you get a higher rate of return and slower if you get a lower rate of return, right? So if you invest in something that goes gangbusters and it makes a whole lot of money all the time, your rate of compounding is going to happen faster. The time that your money takes to double is going to be shorter. So you can easily find out how long this is by taking the number 72, divide that by your rate of return, and that's going to be how many years it would take for your investment, for your money to double. So let's look at an example here. Let's say you're going to do that 10% rate of return, right? So let's say you want to invest in your S&P 500 index for the long term, get the average of 10%. That means your money's going to double about every 7.2 years. Okay, so if you've got $100 invested and after 7.2 years, that $100 turns into $200, right? Because you've gained that value over time. But what if you're not as, let's say, into that risk, right? You don't want to invest in the S&P. You want to invest in something that's maybe a little bit lower but guaranteed, a quote unquote safe return. And you find maybe a certificate that's going to give you 4% a year for the next 10 years. Well, you take 72, you divide that by 4, right? Your rate of return, and you see that it's going to take 18 years for that money to double. So if you invest in something that doesn't return money as quickly, that just extends the amount of time that you're going to need to be invested in order to get that money to double. Now, what that means for you is you can still get the same effect. You're just going to have to put up more up front compared to maybe investing less in something that gets a higher rate of return, right? So this is a quick way that you can do some real basic math to say, okay, how much do I need to invest at my rate of return that I'm comfortable with in order to get to where I need to be? Now, another important thing that we want to make sure we recognize is not everything that you want to save for is an investment. Some things are really just budgeting or savings things, and you don't want to necessarily put that money at risk through an investing platform or an investing cycle, because you want the money to be there when the time comes, right? So if we look at these different things, funding college for an 11-year-old, buying a car in 2 years, buying a vacation home in 15 years, going on vacation in 6 months, putting 20% on a house in 5 years, or retiring in 25 years. Which of these two do you think are maybe short-term goals? You can put it in the chat there. Okay, I see vacation in 6 months. Vacation and car, buy a car. Vacation, buy a car. Yeah, right. These are short-term goals. These are things that we want to do within the next year or two, right? And so what we don't want to do is go and invest that money, and then maybe the market goes down, and we find out that, hey, we don't actually have enough money to go on vacation or to get that car, right? Because we've lost the money that we invested. Those are really more like budget items or like savings items. Those are things that you want to do in the near future, couple of years. And so we just want to save that money, put it somewhere where, if we can get a good solid interest rate, that's great, but we want to preserve that capital. What two do you think might be midterm goals? Things that we want to do soon, but not quite as soon. See, house and college. We got house in 5 years and vacation home in 15 years, house and college fund, down payment, right? So when we're looking at the midterm things, funding college for an 11-year-old would be something, because usually you're going to go to college around 18, right? So that's about 7 years away. And then putting a down payment on a house in 5 years, right? That's a little further out, but not so far out. So with these midterm goals, you can maybe look at a combination of things, right? There are investment vehicles that are made specifically for saving for education, for example. And we'll talk about the 529 plan a little bit later on. Or you might want to save more money for a house, and you might have time to put it in something that grows a little bit faster, because you're not looking to get that money out for another 5 years. And so you may be able to save, but also invest to some degree so that you don't have to save all the money. And then the last two are long-term goals. These are things like buying a vacation home in 15 years. Retirement for a lot of people is a little further out. So anything that's kind of over that 10-year mark, we look at that as a long-term goal and something that's more likely a good choice for investing your money, at least early on, so that you can get more of the return. You don't have to save as much of every dollar that you want to have down the road. So now that you understand the importance of time to investing, let's talk about, what are the things you actually can invest in? There's a whole bunch of different things that you can invest in, many, many different types of them. Here are a few of the common ones: stocks, bonds, funds, commodities, futures, currency and cryptocurrency, and real estate. Now, we don't have time to cover all of these, so we're going to talk about these first three: stocks, bonds, and funds, because those are kind of the typical ones that a lot of people will get started with. The other ones are a lot more, it can be a lot more complex and a lot more nuanced, and fewer people jump right into those. So let's talk about these first three. Before we do, I want to make an important point though. There's a difference between investing and gambling. You can invest in the stock market, you can gamble in the stock market. We are not trying to get you to gamble, right? We're not talking about gambling. Long-term financial strategy for growing wealth, that's an investing behavior. An unrealistic or unsustainable return, that's a gambling behavior. So if somebody comes to you and says, hey, I've got something, you're going to make a pile of money really quick, it's not going to be something you're going to have to do a lot of effort on, you're probably not investing, right? Short-term actions are gambling specific. If it's something that's reasonably predictable over time, you're probably looking at investing. Realistic expectation of returns, you're investing. The hope of a quick return, you're probably gambling, right? So think about these things before you go and throw your money at stuff. We want to make sure that the actions we're taking are toward investing, which is a long-term strategy for growing our wealth in a reasonably predictable way. that has a fairly understood risk profile, right? If you're day trading in the market, you're trying to figure out what's going to go up or down every single day. That's gambling. Just because you're buying stocks doesn't mean that you're investing. You're gambling. You're hoping that you're going to be right on that. So we want to make that point as we talk about the rest of this stuff. Okay, so the thing that most people tend to think about when we're talking about investing, usually what comes to mind first is stocks. So this is what we want to talk about first. When you buy a share of stock, you are actually buying a little piece of that company, right? So if you go and buy a piece of Walmart stock, then you own a little bit of Walmart. And there's a good chance if Walmart does well that the stock price is going to increase. The value of your stock is going to increase, but it could also go down, right? That's a natural part of things. Value goes up or down all the time on stocks. What really matters, though, is not necessarily what the value is from day to day. It's the value when you buy it versus the value when you sell it. When you actually sell your share, that's when you will realize the gain, and that's what you're going to see is the actual value of what you bought and what you pay taxes on. Okay, so it's important to note that the actual value of your stock is not really determined until you sell it. So when people jump into their 401ks or they jump into their investment accounts and they see, oh, the market's had a bad day and I lost $10,000. Well, you didn't lose $10,000 unless you go and sell. If you go and sell, then absolutely you guaranteed you lost $10,000. But if you wait, typically over time, things go up and down, right? It will return, it will come back. And so when you sell is when you actually know, did I make money or did I lose money? We call those paper losses or paper gains until you actually sell, because the value is just on paper, right? What does it say it is right now? But you own it still, it's yours until you go and sell. So we want to make sure that you understand that, because I think a lot of people misinterpret the ups and downs of the market. And we're going to talk more about this when we get to risk and volatility in a little bit. But they misinterpret that stuff to think that they are constantly gaining or losing money. But it's not until they go and sell that matters. Bonds are when a company or a public entity wants to raise some money, but they don't actually want to sell ownership, right? So if Walmart says, hey, we want to raise some money, but we don't want to sell a little part of our company, they could go and sell a bond, right? But typically what you'll see with bonds a lot of times, they may be, hey, the school district wants to go and build a new school. And so they'll go and they'll sell bonds, which is where people say, I'm going to give you a certain amount of money right now. And then over time, you're going to pay me some interest at a specified amount. And then you're going to pay me back all of the money that I put into, right? So after the bond matures, I'm going to get all my money back, plus I'll get some interest along the way based on whatever the terms of that bond are. Now, one of the things that people often will say about bonds is they're less risky, right? Because it's a quote unquote guaranteed return. And that's not entirely true either, right? So there are different levels of risk in bonds. The hope is when you take out a bond, so when you go and purchase a bond, you're giving, say, $1,000 to an entity, and they're going to pay you some money in interest over time. And they'll tell you how much, right? So maybe it's 4% interest, right? Great. You're going to get your 4% interest. And then at the end of your bond term, maybe it's a 10-year bond. You're going to get back your $1,000. In the interim, they've built whatever it was they want or did whatever they wanted with that money. But then they're going to return it to you at the end. However, maybe the entity's not around. Maybe they don't make it 10 years. And you can have this happen, especially with corporate bonds where they even call them junk bonds, right? So a company might say, hey, we're going to give you a bond and we're going to return 15% a year, right? Well, they're trying to entice you with that 15% of a quote unquote guaranteed return because it's a much riskier investment than the school district up the street wants to build a new school and you think they're probably going to be around in 10 years, right? And so understand that bonds carry their own type of risk. It's just a different type of risk than a stock might be. And so don't think of bonds necessarily as just all safe. It's just a different type of risk. And then the last category that we want to talk about here are funds. And funds are what a lot of people end up investing in because they're typically inside of things like a 401k or an employer-sponsored account, or people might buy them in all sorts of different ways. So funds are a collection of other investments that are packaged together and sold as one thing. So when you buy one share of a fund, you're actually buying a little bit of a whole bunch of different things, whatever that particular fund is made up of. And not all funds work exactly the same. Some are what's called actively managed, where you have a fund manager who's choosing, hey, I'm going to put a little bit of this in, or I'm going to sell this out of the fund and buy more of this, right? They're actively moving things in and out of that fund all the time, trying to ideally make it perform better. Or you have passively managed funds, which just say, hey, we're just going to invest in these things. Whatever this is our strategy, we're just going to invest in this, and we're not going to be moving things in and out just because we feel like it. It's got to stick with our kind of our guiding principle of how things get in and out of that. Now, typically a managed fund is going to be more expensive as far as fees go than a passively managed fund, because the actively managed fund has somebody who's getting paid to mess around in there and try to outperform. So they tend to have some higher fees. So the funds that usually you're going to run into are mutual funds. With a mutual fund, you are mutually buying assets with other investors who have pooled their money together. Those can be actively or passively managed, but most of the time those are actively managed mutual funds. The interesting thing about mutual funds, you often have a minimum investment requirement. So it might be, say, $5,000, right? You can't invest anything until you invest $5,000. But then after that, you can purchase fractional shares. So if a share of the fund costs $1,000 and you only have $500, then you can buy half a share, right? So as you buy the mutual fund, once you're in and you can buy a little bit at a time. And all mutual fund orders happen at the same day for the same price. So when you see the chart of the markets going up and down and the value of funds going up and down, whatever you say, hey, I want to buy a mutual fund at 9 o'clock, right? Whatever the price is at the close of trade that day, that's what you're going to buy for, not what the price was at 9 o'clock. So you're going to buy or sell at the same price once a day. So it's not this up or down thing like you see with other stocks, right? Now, exchange traded funds, or ETFs, are mostly passively managed funds. So they tend to have a little bit lower fees than your typical mutual fund. The minimum purchase price on that is not a certain threshold. It's just the price of whatever one share is, right? So you can buy one share. If the price of one share is $20, then you can buy a share for $20, but you gotta have your $20 to get in. They are traded on the open market, so they're traded like a stock on the stock exchanges, and the price fluctuates all the time. But they're bundled like a mutual fund, right? So they're a collection of things that are traded like a stock. Target date funds are what you'll see a lot of times again in employer-sponsored programs, right? These might look like a fund that says, investment 2050. And the idea is that 2050 is around the target date that you want to retire, that you want that money available. And so what it does is the further away from that target date you are, the more aggressive the investments are going to be because they're trying to earn more money. You've got more time until you need it. The closer you get to the date in that target date fund, the more it's going to be more of a conservative asset mix so that it's not fluctuating as much, right? You have more stability in how much is inside of that. So again, you'll typically see these with a year at the end of the name of the fund so that you know you're dealing with a target date fund. And then the last one we want to mention are index funds. So index funds are a broad collection of assets that are used to gauge kind of how the economy or the economic sector is performing, right? And one of the most common ones that you're going to hear is the S&P 500 or the Standard & Poor's 500. So the Standard & Poor's 500 is 500 of the largest companies in the United States, and it looks at these to see how are they doing overall, right? And so if you go and buy an S&P 500 index fund, then you're buying a little bit of all 500 of those companies. All right, so it makes it easier for you to buy a ton of stuff with just one purchase. And here's an example. This is a graphic that shows on a particular day what made up the S&P 500. You recognize any of these names? If you do, type the company that you recognize the ticker symbol for in there. Some of them are pretty easy. Apple, Amazon, Google, JP Morgan, Facebook, Procter & Gamble, GE, yep, General Electric. Yeah, see, these are big companies, right? These are companies that you know. So if you go and buy an S&P 500 index fund, Disney, there you go, see, it's exciting. If you go and buy an S&P 500 index fund, you actually buy a little sliver of all 500 of these companies, right? And so when your price goes up or down, it's based on whether these 500 different companies go up or down. Whereas if you buy the one share of Walmart stock, your price is based on whether Walmart itself goes up or down, right? All right, we're going to try real quick to run through risk and volatility. We've talked about this up and down nature, right? And sometimes people feel like the up and down nature of stock prices in the stock market is risk. And that's not necessarily true. There is a difference between risk and volatility. So volatility is what you see right here, this up and down nature of the market, right? So this is a screenshot of the S&P 500 over a certain period of time. Anybody want to take a guess as to what section of time this particular chart might be showing? Okay, Jamie says 1 month. What 1 month do you think maybe? In some period of history, what period of time? You've got this this one big drop there. Somebody says COVID, March, April, 1989, the 2008 recession. So I love to do this out of context for you, right? Because all it is some squiggles. You have no idea how long this is, right? All right. In the interest of time, this is 2014, November 2014 to February 2016. There was nothing in particular that caused this that you would remember. It was some stock announcements, a few weird things in the Chinese stock market. Some people got nervous. And that big drop there, that first big drop, that's what that was. Stocks went down. Then they regained. And then a few months later, they went down again when the European Union announced that there was going to be this vote on this thing called Brexit, right? And they dropped again. All right, here's another chart. What time frame do you think this might be? Got a big run up, and then there's this this drop at the end there. You got a little bit of a drop in the middle, but time we think this one might be? 2007, 2008. See, everybody's like, oh, I don't know. Could be last week for all I know, right? Jamie says current. This is COVID. This is the start. At the beginning of this chart is what happened right after the end of that first one. So right at the end, that big drop that we saw, this is what happened. We got this huge run up, and then we ran into COVID. And a lot of people got scared. They pulled out their money, right? And so we look at where the drop was at 2,200 there. It was actually not even as low as the highs were in 2016 when we looked at that last chart. And then let's look at things in context, right? So those 3 big drops that we talked about, there's that first chart that I just highlighted. That's COVID. Now, knowing what you know now, did you want to pull all your money out at the bottom of COVID? Right? It was a scary time. But these drops, they happen all the time. Even something as crazy as COVID. If you look at this chart, like, holy smokes, yeah, I want to be invested for the long term, right? I wish I put a bunch of money in 2014 because I see where it ended up. You know, that this is toward the end of 2024. So the point is, we want to understand that risk and volatility are not necessarily the same thing. Volatility is a natural part of the markets. It happens all the time. Here's one other chart for you, and I know we're running pretty close to time for you. What would happen if you invested in 2001, $100, is that over time, the purchasing power of that money would go up to about $300 and almost $350. If you had put the same $100 in a piggy bank in 2001 and cracked that thing open in 2024, you would only be able to buy about $53 worth of goods for that same $100. Because if you think about it, $100 bought a lot more groceries back in 2001, right? So there's risk in safety too. Just putting your money in the piggy bank doesn't mean that it's not at risk. It's a different kind of risk, right? You're running into inflationary risk. So you're losing money every day that you just leave your money sitting in a safe place, and it's not working for you to maintain or grow its value. It's about being in the market for a long time, not timing the market, right? So time in, not timing. If you invest regularly in, say, a 401k or something like that, every paycheck, you are putting in all the time what's called dollar cost averaging. You're putting in whether the market's up or down, and over time, data has shown that you're going to do better than if you try to time the market and you try to figure out, oh, if I put it in now, it's going to make a bunch of money, or I better wait because I think it's going to go down. You aren't going to be able to guess. There are people who make millions of dollars every year. They can't figure it out either. So the safe thing to do for you is just dollar cost average, regularly put stuff in over time, and just leave it alone. Just let it sit there. All right. And I am going to run out of time. I do want to say, a good question we get a lot, right, is should I save, should I pay down debt, or should I invest first? What you do is going to depend. I would say, generally speaking, if you don't have any emergency savings, you don't have anything to fall back on, you definitely want to save some money first, right? Save something for an emergency fund, $1,000, something like that. If you have consumer debt, like high interest consumer debt, like a credit card, you're paying 20, 25, 30%, right? If you're paying that amount of money in interest, I'm sorry, you're going to have a hard time outrunning that in an investment, in a safe investment. So you want to really work on paying down your high interest credit card debt before you start really throwing a lot of money into investing in the long term, because you're not going to invest and make more with your investments than you're paying in credit card interest if you've got something like credit cards or, heaven forbid, payday loans, something like that, right? So that's another one. Jamie says, buy real estate, ? Depends, right? That depends. That would be one for a financial coaching discussion, one-on-one to do. All right, so normally I would run into investment accounts now, but I think we're out of time, Sadie. Is that that's accurate?
It is, but I'm sure folks want to hear that, and we are recording. So if you have to hop off, maybe we keep going, and
Okay.
we could send out the recording.
Let's do it. I like it. So we can run through the last bit and then maybe answer a couple questions, and people who have to hop off can go for it.
Thank you so much.
Yeah. So let's talk about some of the common investment accounts that you're going to run into. We've got employer-sponsored accounts, right? Employer-sponsored accounts are things like your 401ks, 403bs, 457Bs, simple IRAs, TSPs. These are things that you get access to by virtue of the specific employer that you might be with at the time. Then there's non-employment-based accounts, things that anybody can open, like an IRA, an individual retirement account, or a brokerage account. You can open a brokerage account at your Fidelities, your Schwabs, your places like that, your Vanguards. And then there's specialty accounts. These are things like health savings accounts, right, where the money is tax advantaged if it's used for its intended purpose, which in health savings account would be your healthcare costs, or a 529 educational account, which are accounts that you can save for to use for certain educational expenses. And that's actually grown quite a bit over the past several years as to what those things cover. Now, each type of account has its own set of rules about when you can put, how much you can put in, how much you can take out, what you can take it out for, when, all of that good stuff, right? So I'm not going to go through all of that because, frankly, a lot of those things change. And you can find some really good information with just a quick internet search, right? What are the rules around a 401k contribution or withdrawal? What are the rules around a 529 contribution or withdrawal? You're going to find good information that way. One thing that a lot of people wonder about is they hear traditional or Roth accounts, and it kind of gets confusing, right? Here's what the difference is between these two things. It's really just when are you going to have to pay taxes on the money for that account? If it's a traditional account, then you're not going to pay taxes on the money today. You're going to pay taxes when you take the money out in the future. If it's a Roth account, you're going to pay taxes today, and you're going to put those dollars into that account. But then when you take the money out in the future, you're not going to pay taxes on it at withdrawal, assuming you meet all of the other qualifications, right? All the other things. So if you're concerned like, oh, I don't know which one to choose, so I'm just not going to invest, don't let that be the thing that stops you. There's not a bad decision when it comes to investing for your future. You can choose one or both of these, and you can change your mind in the future, right? So if you qualify for a Roth and you want to put money into a Roth, that's great. If you aren't sure, you maybe just want to put it in traditional, you can do that and you can change your mind, or you could do a mix of those things too, right? So don't let that be the thing that scares you. There are also some, usually you'll hear Roth with the IRA. You can now do Roth 401ks with some employers as well. So that's a consideration that some people have to look at as well. One question is, of course, what are the restrictions around the different accounts that you want to invest in, right? There's usually some sort of an income qualification on certain accounts, right? You can only invest into a Roth IRA if you make under a certain amount of money as a household. There might be an employment qualification, right? You can only invest into a 401k if your employer offers it. There are contribution limits with everything except for a brokerage. There's withdrawal age qualifications, right? When can you take the money out without facing a penalty? There's qualified uses. So think back to those HSAs and those 529s, right? There's certain things that money can be used for. Otherwise, if you use it for something else, you might have to pay a penalty for it. And then, of course, the penalties are different depending on the different types of accounts. One question we often get is, how do I start investing in an IRA? You just have to have earned income, right? And so actually a child can invest in an IRA if they've got earned income. If they're under 18, you'll have to open what's called a custodial IRA. But if they're 18 or over, then they can open their own IRA. As long as they're reporting some sort of income to the IRS and paying any taxes that they may need to, they can invest into those IRAs. So you can open up a Roth or a traditional IRA really through just about any provider. You can find those on a lot of places. People will have like a Fidelity account, or they might have a Schwab account or Vanguard account, or you can open through like Betterment, some of the robo-advisors, things like that. The maximum contribution is up to $7,000 in 2025 if you're under age 50, or $8,000 if you're over age 50. They let you do what's called a catch-up contribution if you're over age 50. Because if you think about our friend from earlier, Brad, he had to save a whole lot more money in order to become a millionaire, right? So they give you the opportunity to save more, under the assumption, hopefully you're making a lot more money toward the end part of your career versus when you were just starting out. Another question that we have often is, what if I change jobs? What happens to all that stuff? Usually you could leave your stuff in your current plan. You could also usually roll it over to an IRA. So if you have a 401k from an old job, you could roll that over into an IRA and then direct that yourself. You could possibly roll over into a new employer 401k if that was something that was offered by them, if they were okay with that. You'd have to check with each employer to find out whether that's okay. The last option is one that a lot of people like to do or want to do, which is cash out. And I'd really, 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 really recommend that you don't do that because you're really taking from your future self, right? Cashing out, you're going to pay penalties, you're going to pay more income tax that year, and then you're not going to have that money there for you in the future. And so if that's what you're looking at, remember, even if it doesn't look like it's a lot of money, that little amount of money, with its given time to compound longer, can be big, big things. And so do yourself a favor and try not to dip into those accounts when you get the chance. Is there a penalty or tax if you roll over a 401k to a Roth IRA? Generally, no. Especially if you do what's called a trustee to trustee transfer, which is really easy. It just means that you don't handle the money yourself. So you can take a 401k, roll it over to a Roth IRA, as long as you're not taking the money out to do that, then you're good. If you do get a check in your hands and want to transfer it over, then there are some chances, if you don't do it within a certain time frame or a certain way, that they might say, oh, well, you took the money out, right? So usually, though, it's as simple as pushing a few buttons on the site where you say, hey, I want to roll something over to you. They'll say, great, where do you want to roll it over from? What's your account information? We'll send the paperwork. We'll let you know when the transfer is done. They'll take care of the whole thing. You won't need to be really involved whatsoever other than initiating that transfer. And there are no penalties or taxes for doing that because you're not actually getting to the money, right? You're just moving it from one investment vehicle to another, and it's just kind of a wash. It is sometimes you want to work with a financial advisor. You don't always have to, especially if you're just starting out. Financial advisors tend to want to work with people who have money, right? Because they got to get paid and they usually take a piece of the assets that you have. And so if you don't have a whole lot, you're just getting started, you really don't necessarily need to work with a financial advisor. But as you get more invested and you want to see, hey, what's my retirement path look like, that sort of thing, it helps to work with a financial advisor. Before you do that, educate yourself a little bit. Spend some time doing some homework to know what questions you should ask, to understand what some of the different investment options are, at least at a high level, because you want to be able to find somebody that you trust. And when you can talk to that person and they don't have to explain maybe every little thing to you, you become a much better client to them. They can help you in a much better way if you do a little bit on your own to say, hey, here's what I'm trying to do. Here's what I know. Help me figure it out from there, right? Always ask how they're compensated. You want to know, are you being compensated because you're putting me into a certain type of investment? Or are you being compensated because I make money over time and you get a little piece of the money that I make on top of that, right? But be an active participant. Don't just say, hey, I'm paying you to do all this for me. Hands off. I'm not going to pay attention. Nobody is going to be more invested in making sure that you have money for your future you than you are. And so you need to act that way. You need to make sure that nobody is looking out for your money more than you are, and ask questions, make sure that they're doing the things that they need to be doing. All right, some action items here. Determine your goals. Figure out what it is you're trying to save for. Figure out which account might be the best for those goals, whether that's your long-term savings, short-term savings, mid-term savings, that sort of thing. You can meet with an advisor. A lot of times, I think you guys all have access to your Utah Retirement Systems advisors. You can go chat with them. I think you even get points for doing that. But start saving as soon as possible so that you can make that happen. And if you wouldn't mind, we've got a quick 2-question survey that just lets us know whether this presentation was helpful at all. I see one question that came in: how are Mountain America financial advisors compensated? I believe a lot of them are assets under management, so they get a percentage of the total pot of money you've got. Some of them are also going to be fee-only advisors, so you could just go and talk to them, and it's like a regular appointment. You just pay a fee for the appointment time. So kind of depends on your advisor and what you're trying to do with them, but that's typically how you'll see them compensated. All right, Sadie, we hit it. A little over, but
Excellent. Well, thank you. It was such valuable information that we needed to go over. If there aren't any last minute questions,
yeah,
we'll wrap it up for today.
happy to answer any questions people might have.
Okay, just lots of
Thanks,
thank
everybody.
yous.
Yeah.
All right. Well, thank you so very much. I'm going to email all of those that were here today about our March 20th event, the Game of Money, where they can bring their tweens and teens. So be on the lookout for that, everybody, and enjoy this snowy day.